Welcome, everyone. Welcome, everyone, to Tax to the Max. Let's get our slideshow started from the beginning. And we can still see each other over here on the side. And you can hold your hand up. If you should have at the bottom of your screen, you should have a little area where you can, I believe it's some functions or something or another that you can actually wave a little hand and I'll see that and call on you and you can contribute, ask questions, start an argument, whatever seems useful at the time. This is Tax to the Max. We acknowledge the help of Tax Notes Today, a publication from tax analysts. In my opinion, tax analysts is the preeminent source of current information for tax professionals, and they do a great job for tax professionals in Washington, D.C., making sure that the IRS doesn't engage in bureaucratic three-card money and keeping information from us that we all are entitled to. If you have questions, please send them to this email address. I will copy those folks at SCAPA that will be concerned about it. We may put an anonymous reply up on the website, but your questions are really valuable because I can think of questions I think people should ask, but maybe I'm not the be all and the end all on that. What's on the program this week? 6 items. The frequently asked questions on the third round of economic impact payments. And the reason that I keep throwing those into this program is the IRS has said that those are to be treated as gospel. Those you can rely on those. So if in fact a frequently asked question can be relied on, we need to know when it was published, to keep a copy of it so that we can prove we had that FAQ, we were guided by the FAQ, and that was official guidance. Then we have more guidance on non-willful foreign bank account report penalty assessment, and that's the special subject this week, willful versus non-willful. I realize that you say, well, come on, Lynn, I don't get involved in all that very often. It's the very often qualifier that causes me to include things like this in this program. If all I ever talked about was where to put numbers in the boxes and what form to fill out for the disposition of property, this would be a pretty dull program. Next, the statute does not run on a net operating loss. I was on the phone with something exactly this issue about half an hour ago. Client firm is trying to, on behalf of a client, they're trying to carry back an NOL. The IRS has said, this is very interesting. And we see that you filed a return with a loss. And yes, the statute of limitations has run on that return, but it has not run on the NOL. If you intend to use the NOL, you're going to try to use the NOL in a return in an open year, we have every right to audit the net operating loss. Now, we're not going to audit the return, mind you. We're going to audit the net operating loss. And that can be a really big deal, as I was learning this morning. More on the foreign bank account reporting filing obligation, a fact sheet, which is to be taken again as authority. And the IRS picks on the little guys and can prove it. And I believe it's a question of agency competence. And I'm willing to defend that. And if anybody wants to take issue with that, I'm occasionally have been reported to the IRS, and I've had calls from they have an agency for practitioner information or some agency to intimidate people like me from questioning what they do. Over the years, I've had a question or two from them, but I believe it is a question of agency competence, but we should not be surprised and we should not be hypercritical either. We'll talk a little bit about that. Another practice unit, this time on deferred compensation received by a non-resident alien. Okay. Your practice is owner-managed businesses and individuals. Okay, You don't have any non-resident alien deferred compensation. Okay. But perhaps someone on this call is in the finance department or the tax department of one of the international corporations that has operations in South Carolina, and you need to know how to treat deferred compensation earned in the United States payable to a citizen of another country. We're going to touch on that. We have members in the South Carolina Association from all walks of practice. We have people that only work on 1040s. We have people that only work on corporate mergers, and we try to have a little something of interest to everyone. FAQs on the third round, 1, 2, 3. The referee gives the signal for a third down. That's so we don't get confused. This is you can find this at the IRS website, answers to frequently asked questions about the third round of economic impact payments. They address eligibility, how to calculate the payments, how to calculate a plus up payment. You did not get the full amount of the economic impact payment because you didn't file or your income was off. You now can get a plus up. You can get a makeup amount, and then how to reconcile that on your 2021 tax returns. And I just couldn't resist, and more, like you get from the commercials on television. Now, non-willful versus willful. When is this important? It's important when you're discussing penalties. Several penalty provisions in the code have one level of penalty for non-willful violation of the rule and a severely increased penalty for willful violation of the rule. What is willful and what is non-willful? How do we tell the difference? I'm not a psychiatrist. I don't know how to gauge the client's state of mind. So the IRS has tried to give us some guidelines. Non-willful conduct is defined as conduct that is due to negligence, inadvertence, or mistake, or conduct that's a result of good faith misunderstanding. Non-willful, oh my golly, I made a mistake. That's non-willful. There is no bright line test to determine non-willfulness. You got to make your case to an examining agent in most cases. Willful conduct can be inferred by the authorities if the taxpayer acted with reckless disregard or willful blindness. I don't see it. We don't see it because you're not turning your head, fool. That's willful blindness. Reckless disregard is, the code might say something about that, but I don't want to know, so I'm not going to look. Either of those is represented by generally knowing there's some sort of rule, but choosing not to be informed as to how it applies. Don't look. You might not like what you see. That's willful. And that will get you an enhanced penalty in virtually every penalty phase in the Internal Revenue Code. So here we've got a non-willful failure to file. This nice lady, Miss Hadley, made a mistake. She didn't know that she was even supposed to be filing the FBAR form. In 2011, she had an interest in 18 foreign accounts. In 2012, it was down to 5. That's $230,000 worth of non-compliance. That's $10,000 for each account. And she said, well, no, wait a minute. That's only 2 years. So I filed one FBAR form for each year. That's only $20,000. I'm sure you see the problem with her argument, right? The penalty is per account, not per form. And the U.S. District Court in the Middle District for Florida, Tampa Division, had no trouble reaching what I believe is the correct decision. Will Ms. Hadley appeal? Probably not, because there may be practitioners' professional liability insurance in here somewhere. If a practitioner gave her bad advice, she might seek to be reimbursed from the practitioner's liability insurance. Now, speaking of foreign bank accounts, I've searched, by now, you know, I have a subscription to ClipArt, right? Just so I can express myself graphically, not just with the words and with my hands. So, well, you know, foreign bank accounts, let me see what foreign bank accounts. So we had a little quiz before we started here, and Catherine and Whitney we can all identify the first four: dollars, euros, pounds, and yen. And that's it. I don't know what those other symbols are for foreign currencies, but I'll bet you that there's a CPA working in South Carolina, either in public practice or in the finance department of a public corporation, that knows and deals with one or more of those foreign currencies that are represented in this graphic. What do we need to know about the foreign bank accounts? Well, we need to know the details and when a U.S. person needs to file that account. The fact sheet that we're talking about here tells you exactly the specified financial interests in the certain types of accounts and in which countries you have to file the FBAR form. If the aggregate value of those accounts exceeds $10,000 at any time during the calendar year, you got to file the FBAR form. It's not the average value. It is the aggregate. Aggregate equals the total value of all accounts expressed in US dollars, by the way, not expressed in yen or euros, on any one day of the year, or on the highest value on any day, plus the highest value on any other day of any other accounts. It can be a very complex calculation, but my advice is, when in doubt, file the form. You have nothing to lose by filing the form, and you have $10,000, $20,000, $30,000 to lose if you don't file it correctly. Tax deductions, ladies and gentlemen, require proof. A net operating loss in 2015 can be carried forward to 2021, you bet. The statute of limitations, however, bars the IRS from auditing the 2015 return. That's a done deal. They can't audit that return, but I've never tried to use the loss. The loss now becomes an item in the 2021 return, and the IRS can audit my 2015 return to the extent of the NOL. They can audit the items that contribute to the NOL. So when you seek the benefit of an NOL carry forward, the IRS can examine the NOL as part of examining the deductions that are claimed in the 2021 return. And this is here because I get phone calls from client firms and from people that just have a question, that get in this trap. Especially, we've had some complicated NOL carryback rules starting about the last 5 or 6 years, and we've had this issue come up more than once. So that's why it's here. Be careful about relying on that NOL if you can't prove that you actually had a loss. Edgardo Villanueva tried to claim an NOL from 2009 in his 2013 return. The problem, he had not established a loss in 2009 that could be carried forward. His records actually supported a loss in an earlier year. And he tried to he lost money on the sale of a house. He tried to create a rental loss, which would have been eligible for an NOL, by simply advertising a property for rent. But it wasn't rented. It was advertised for rent for 2 months before he sold it at a loss. That did not establish a business use of the property which was adequate to produce an NOL. Bottom line, the IRS can challenge an NOL when you claim it. You're seeking the tax benefit in a current year, and that can be challenged. Shooting fish in a barrel. Our friends at the Internal Revenue Service. And I had to find 2 separate illustrations. One to get this frightening masked figure over here, and another to get this poor innocent fish that's being blasted probably for no reason at all. Here are the rates of income tax audits. These are expressed as a percentage. 7.9% of low-income wage earners are audited in 2020. That goes up to 13% in 2021. And if it continues at the present rate, it will be 13.5% in 2022. Meanwhile, other taxpayers above the low-income wage earner line, above $25,000 of taxable income, are only taxed at 2%, 2.6, 2.2. What? What the hell is going on? In a society that is supposed to treat everyone equally under the law, why is this fearsome revenue agency that can take my money and take my property and actually put me in jail? Why are they auditing low-income people at a higher rate than the high-income people? I think it's a great social question, but I'm not a sociologist, I'm an accountant. I want to acknowledge the copyright on this material that's held by Syracuse University on the Transactional Records Access Clearinghouse System. I quote this here, and I claim exemption from the copyright under the fair use doctrine, so everyone understands how I can use copyrighted material. So far this year, the IRS has completed 133,000 audits of low-income wage earners with less than 25,000 in total gross receipts. The audit rate for everybody else is 2.2 per thousand. Come on. How about some possible reasons why? Well, there may be more of them. I may not have them all. That 13.5 is a percentage, not an absolute quantity. That's remarkable. That's frightening. In comparison, do more low-income people make mistakes? I don't know. A lot of low-income people get help from a tax prep service, or they go to H&R Block, or they buy a TurboTax software and they get help with that. Are low-income returns inherently more complex? Historically not, but I don't know. With all the subsidies and the credits, I still doubt it. When you think about trust distributions, partnership allocations, and S shareholder basis issues in those high income returns, there's a lot of fertile ground to plow there that it seems to me the IRS should be plowing. So what is it then? I'll tell you what it is. Based on my personal experience, right now, at the present time, the IRS does not have enough competent auditors to audit complex returns. If they put them in the field, it would be an embarrassment. And so they hang around the office, supposedly in training, and they do office audits, correspondence audits, and those count in that 13.5%. So someone made a mistake on their child tax credit or some other credit or some other adjustment, and they get this threatening letter from the Internal Revenue Service. Is that the future? Is the IRS committed to only pick on those that are less likely to be able to defend themselves? I hate to think so. Next, we get guidance in the form of a practice unit. This is to train some of those people that I just criticized. These people need to be trained on the circumstances in which a salary paid to a non-resident alien, which was earned while they were working in the United States, but was deferred because of a deferred compensation plan, either a bonus plan or a 401k or some sort of a top hat program. 3 questions have to be considered. And I'll use the non-resident alien, NRA acronym. Has the non-resident alien ever performed services in the US? If the answer is yes, then you're going to have to be concerned about a payment of deferred compensation where the payor, the U.S. taxpayer, seeks to claim a deduction for it on its United States tax return without accounting for the potential for withholding and the potential for other foreign reporting issues. Is the non-resident alien resident in a treaty country? Oh, wow, that could change everything. If I pay deferred compensation to a resident of a treaty country, I have to look at the tax treaty with that country to see what the rules are for how they're going to treat the payment of deferred compensation to our citizens. We have United States citizens who go to the UK to work, who go to Germany to work, who go to Saudi to work. We have citizens of those countries that come here to work. And this is a ever-present subject. What U.S. withholding rules apply? Because if I don't withhold and take the money out of the payment to the non-resident alien, I'm going to be liable for it anyway. So get a situation where I give the non-resident alien all the money, then we discover we should have withheld, but the money's gone. I still have to make the withholding payment, make the payment as though I had withheld. It's a serious risk for those that are dealing with deferred compensation for workers who come here to work and are here for maybe a year, maybe half a year, and then they go back to their country of citizenship, and we pay them after they leave. We pay them a bonus. That you need to set up a procedure to make sure that you get the withholding properly. Compensation which is typically considered would be distributions from a tax qualified retirement plan, payments under an unfunded top hat plan, income which arises under an equity-based compensation. If the non-resident alien worked here for 2 years and had stock bonuses, you're going to have a unique withholding issue when that non-resident alien sells the stock, realizes the value of the bonus, and you now may have a withholding liability. Is it worth it? Should we continue to meet every week? This call is usually at least 20 minutes, sometimes 30 minutes. I think we went as long as 45 minutes once. We try to deliver useful information, but I really would appreciate your help. Send a question, send an email, anything you would like covered in this program, something you read about this week or something you read about last week and I didn't talk about. Let's put some life in this thing and have some fun with it. We're all in different places, so we can't have the physical celebrations. We can't make coffee for one another, but we can certainly share information, and I would be privileged to answer questions that would be useful to you in your practice. That's it for this week. I've been at this a long time. I just realized I looked on the wall where I've got this thing hanging. The Ohio Society gave me their gold medal for contributions to the profession in 1995. I thought maybe I was supposed to quit, but they said no, I didn't have to. So here I am. Until next time.